Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me we have a new look Bazaar today. Ekta and Mangalam join in as well. Good morning, guys. Halfway through the week. Interesting times ahead.
Interesting times ahead. It was interesting times yesterday and day before as well. So many things happening, yet nothing happening, yet so many things happening. I mean, it's the middle of the week. You want it to be a Friday.
Indeed. And Ekta, good to have you on the show.
Hi, guys. Yes, absolutely. It's great to be on the show and a lot of nothing happening, but it's better than what was happening a couple of weeks ago for the markets. So definitely from that perspective. But the FII sell figure was quite worrying, I would say.
Well, that's right. We'll keep an eye on Mangalam on the markets and also an eye on Wankhede this evening. Hopefully, we don't get some rain and hopefully Mumbai can pull up the win. I guess you're going to be at the stadium.
I won't be at the stadium today because it's raining and you don't know, the uncertainty that there is. But be that as it may, if you just look at the market yesterday, some of the portfolios, while we're watching out the Battle of the Blues today, which is the Mumbai and the Delhi teams, it's the battle of the Reds in the markets yesterday. If you look at both the Nifty as well as the Nifty Bank, there was a sharp pullback that we saw in yesterday's trading session. But your portfolios would have hurt because earlier when the Nifty and the Nifty Bank were consolidating, the frontline indices were consolidating, we had the broader markets outperform. But yesterday it was the broader markets which underperformed. We had the mid-cap as well as the next 50 indices down almost 2%. The possible reasons for decline, you club it in three broad buckets. One, concerns around the US economy. Second, China interest rate cut, which may direct flows to China. And the third part is fear of rising COVID cases. We saw the IT index underperform yesterday. We saw the metals outperform yesterday. So those two played out. If it's the third, then we'll have to watch out for two pockets today, the hospitality stocks as well as the diagnostic companies, because those are the ones that rose earlier as well. But the one number that defined the market action yesterday came post-market. That was the FII flows, 10,000 crores worth selling. We were looking for cues, whether it is a one-off, whether it was a large trade. Seems like none of that. It is a 10,000 crore selling that the FIs have done, and it's the largest that we've seen all the way since February 28, 2025. In that, we have to watch out for levels. The Nifty Bank below the 20-day moving average. The last time it did bounce from those levels. And the Nifty 20-day moving average is 24,500, which may be an important support. We'll watch out for all those levels. Nigel will talk about the FNOQs as well. But I'm just looking at a couple of other important macros overnight as well. Wall Street saw a decline of anywhere between 0.3 to 0.4%. Dollar index cooled off a mild bit to sub 100. Brent has been rising. Over the last few trading sessions, it's actually rallied all the way up 10% to 66.5. And gold continues to be around that 33 as well, $3,300 per ounce. While there was a decline on Wall Street yesterday, I will keep an eye out on how Nasdaq performs today. Why do I say that? Because there were big launches that came in from Google's summit, where they've launched VO3, an AI video generator, which also creates audio. So it's one step ahead of the one launched by OpenAI. And it's also announced a $250 per month premium AI subscription plan. So take us for that. Could keep the Google Alphabet stock in focus today. And a whole host of other Nasdaq stocks that I'll be watching out for will be Tesla, Nvidia, and AMD. Why? Because Musk has said he will spend a lot less on future campaign donations, which is positive for Tesla. And secondly, we'll continue buying chips from Nvidia and AMD. That's positive for these chip makers. So while Nasdaq was down overnight, I'll watch out for how it performs today. But by and large, what was the dominant factor for the market in yesterday's decline is something that we'll find out today. The traction on hospitality and diagnostic stocks will be crucial. But Nigel, a lot took place in the flow side as well.
Well, that's right. First up, in terms of that FI big net sell number, I am not yet worried about that because yesterday it appeared that, in fact, there was a risk-off that played out. And that could be a case where the US yields spiked up. So there was money that was flowing to treasuries rather than equities. So I'll guess that, in fact, the sell-off that we saw in the Indian markets could be part of the emerging market sell-off. We'll have to wait by to see how that plays out. And also, we have the monthly expiry that plays out next week. So hopefully that's not a change in trend, and hopefully you're not going to see a big FI net sell number. What do the FIs do in the index futures, though? They added some short positions. So they added close to 5,000 short contracts and they unwound 9,000 long contracts, which tells you why we had the short positioning that moved up from around 24,000 contracts. It's moved to around 39,000 contracts or thereabouts. Some shorts in the system, not such a bad thing as I always say. What about the clients? Well, in yesterday's trading session, they went ahead and they added some longs as well. So you just look at the long addition, they added closer on 25,000 net long contracts in trade yesterday. Moving to the FI data, though, in the stock futures, they added some mild shorts, they unwound some longs as well, and we've seen this over the last few trading sessions. So that's about what the FI as well as the clients are doing in the F&O market. But I'm not yet worried because of a couple of factors, and I believe that maybe at some point of time today, we see a bounce from the lows of the day. The reason I'm giving you, yesterday the Nifty was down 260 points. Yeah, it has an inverse relation with the volatility index, but yesterday we didn't see a big move on the volatility index, and that's normally the fear index. So, that's one point that I'm looking at. The second point is on the PCR. Just a few trading sessions ago, the PCR had moved to around 1.3. From around 1.3, it's come to the lower end of the band at sub 0.7. Normally, we see at around that 0.65 odd, we see the Nifty bounce a little bit. So I'll be keeping an eye on that parameter. The VIX not spiking up and the PCR at the lower end of the range give the bulls some kind of hope. Though, in fact, we should look at the options data. And the reason that the PCR came down, because the call writers, they feel they're back in the game. 24,800 call, 25,000 call, both of them added a good amount of open interest yesterday. However, there was some addition at around the 24,500 odd mark. So in terms of levels that I'm looking at, going by this option data, that's the 24,500 put seeing some writing. The 20 DMA as well comes in around that. This is the crucial support, 24,450 near-term support. You don't want this to break. On the upside, we've been seeing for the last few trading sessions that the 25,000, 25,125, that's a bit of a resistance zone. Moving to the Nifty Bank, well, that one as well will be important. It needs to defend the lows that we saw last week. I don't want to see this level getting violated, 54,400 odd. So I expect a bit of a bounce from the lows of the day, and hopefully the FI net sell number doesn't pick up. In terms of stocks that I'm looking at Aegis Logistics. There is, that expectation of them unlocking some value via an IPO of one of their joint ventures that they have. So the company will get some money. And the last few trading sessions, actually, the stock has been quite strong. And it's been backed by good amount of delivery-based buying. In January, it was a 1,000 rupee stock. It corrected a fair bit, and now it's seeing some good delivery-based buying. Just take a look at that. Yesterday's trading session closed on 2.4 crore shares getting delivered, which is much higher than the 10-day average and much higher than the 1-month average as well. So that's a stock that I'll track, guys.
Okay, all right, Nigel. Thanks very much for that. So yes, definitely the FII flows is something that we will be watching. But besides that, just wanted to touch upon a couple of macro data points. The core sector data for the month of April was actually quite weak. It came in at around 0.5%, which was an 8-month low. Remember that it's 40% of the IIP. So the street is probably now anticipating that the IIP figure for the month of April could be around just about 1%. In terms of a couple of other cues, the earnings season. So we have IndusInd Bank, which is coming out with numbers today. That's important to watch out for. Besides that, we have ONGC as well as Colgate. So those are a couple of key points to watch out for in terms of results. Separately, I think I would keep my eye out on what's going on with Israel and Iran in terms of the Brent crude prices. Right now, not seen a huge rise, but nonetheless, the situation between those two countries would be something that we should keep on our radar. And separately, India-US trade negotiations, where that is heading, I think that would be an important cue. But some relief because the southwest monsoon is expected to hit Kerala 1 week early. This is the first time in 16 years, Mangalam, that's going to take place. It's a big relief, I think, to all of us.
It's a big relief for a lot of us, but we'll have to watch out for the implications of this on the agri and more importantly, all the AC sellers. They were bracing for a very hot summer. All the summer companies, were expecting good offtake this time around because summer had set in early. But now if monsoons are coming early as well, so all these, inventories that have been piled up at those stores, let's see whether they sell or not. But let's get in some equity call. We have Ridham Desai of Morgan Stanley saying that the drawdown in Indian stocks from their September 2024 highs is actually an opportunity to buy India's long-term story. He says they raised their EPS estimates by 1% to reflect the GDP growth forecast upgrade. He also says their sensex target, the new sensex target for June 2026 is 89,000, bakes in their new earnings estimates. Also roll forward from the December 2025 target of 82,000. So 89,000 was the sensex from the House of Morgan Stanley. Them also add they are overweight on financials, consumer discretionary, industrials, and they are underweight on energy, materials, utilities, and healthcare. He says it's likely to be a stock picker's market in contrast to one driven by top-down or macro factors since the COVID pandemic.
Okay, well, let's get some more perspective now. We have Jeffrey Dennis, independent emerging markets commentator, who's now joining in. Jeffrey, hi. Thanks very much for taking the time out and joining in. Well, let's start with your whole entire outlook on the Indian markets, considering that we were just discussing how there was a large FII sell figure that we're reckoning with this morning. And separately, you know, the Indian markets have been a bit cautious. They've been down for 3 days in a row now. Give us your sense in terms of how you're approaching India.
Well, I think what we've got to realize is that you've seen a very nice rebound in emerging markets generally in May. In particular, some of the markets like Taiwan, which did so poorly earlier in the year, have done very well on the back of concern over on the back of concern over tariffs beginning to ease as Trump starts to try to do some trade deals with individual countries. And so I think what's happened is India's been pushed a little bit onto the back burner here in the short term. India's been a reasonably solid market taking the year as a whole. It has not been hit like Taiwan was hit earlier in the year, and China remains, in my opinion, very volatile. And so, albeit recovering also in May, and I think India's just taken a bit of a back seat here. But I continue to believe that the outlook for India is good, based on the strong economy, still strong economy, albeit possibly slowing, potential for interest rate cuts after that low inflation number for April, and obviously a very nice rebound recently in the rupee as well, which probably opens up room for the RBI to cut. And you've obviously got reasonably stable to slightly lower oil prices, all of which is good for India. So it's been a bit out of the limelight recently. And I think that just reflects that other markets have done better because of the big focus on in particular trade deals and what the prospect for trade deals could be.
All right. Hi, Jeffrey. Good morning and good to see you, Ben. What are you making of the U.S. deficit numbers? Now, clearly, that's spooking sentiment a little bit because even overnight, you saw a flight towards, towards less risk assets. And a lot of those risky assets did get sold into. The yields have spiked up as well. How much of a worry is that for global equities?
I think it's a major long-term worry for global equities. So clearly, we were due some profit taking in equities because we had a very good run in the US. But I think what's slightly changed the outlook here in the very short term is the Moody's downgrade of the US from its highest rating, its highest debt rating, which came out on Friday. And that's started to weaken US bonds and pushing yields therefore higher. And I think that is coinciding, of course, that downgrade with the pushing through Congress gradually of this fiscal bill, this big beautiful bill, as President Trump calls it, which is going to add a lot more to the deficit. And so I'm very concerned about the deficit. I don't know when it's really going to hit. There is clearly some alternative pull on bonds through the risk of recession, which would tend to pull bond yields lower. But my view is bond yields are flat to higher from here. The higher risk, the risk of higher yields is because of the fiscal side, which is bad anyway. And nobody seems to care in Washington, D.C. about the deficit anymore. And the deficit is going to get worse if some sort of a bill like the one that is beginning to make some progress through Congress, if that is eventually written into law. So, yes, I'm very concerned about it.
You're concerned about it. So the question then is, what should one do with their portfolio allocation? Because gold is at a record high. Yields are increasing. So do you shift some of the assets to, risk-free assets, the yields because or the 10-year, if at all, or the fixed income? Yeah. And if you were to increase your exposure to equity or keep your exposure to equity same, in that, what would your pecking order be between developed and emerging markets?
Well, I think the key here is going to be what does the dollar do? And the dollar's had a very nice rebound, a modest rebound recently. And then the last couple of days, it started to weaken again. So I think the dollar goes down again. And I think it goes down again because of everything that's going on in the US, the uncertainty generated by the tariffs and the trade war that is ongoing, the concern, of course, about the debt and the deficit once again, and risk that the economy is heading towards a major slowdown, potentially even a recession. So the whole idea of selling the US, if you like, I think is beginning to come back into the forefront again. So if you get that developing further, I think that's going to be very beneficial for emerging. And so my view remains, as it's been, it wasn't at the start of the year, but it very much is now and has been for a few weeks, that emerging markets will outperform developed markets, assuming these trends continue. And for that, as I've often argued on this show, the weaker dollar is very, very important. I think gold still looks good because if the sell US continues, and that will be very much driven by the fiscal side, I think gold will probably do well again, although I'm far from being a gold expert. And I think you've got to be very cautious about certain parts of the developed world in terms of equities, particularly the US. Europe less so. I think Europe looks in a better position. And at the same time, I think you're going to be very, very cautious about bonds.
You be cautious about bonds. You are sell US. You believe gold is going to do well, and Europe likely to do slightly better than the US itself. Thank you so much. Always a pleasure speaking with you. Wish you a very good day going forward. With that, let's tell you what the interactions that are lined up for you on the show today. Coming up at 8:35, the management of Belrise Industries, the IPO. The company starts or opens their 2150 crore IPO, entirely fresh issue. At 9 a.m., we'll be joined by the management of Bazaar Technologies as it acquires UK-based Curve Games for about 250 crores. 9:20, we have Nimesh Chandan of Bajaj Finserv Asset Management, the market master of today. And then at 9:30, the management of Dixon Technologies with us to discuss their fourth quarter earnings.
Following that, Abhay Soy of Max Healthcare will be chatting with us at 9:40 a.m. for their Q4 performance. A little later at 9:50 a.m., Akshay Kumar Singh of Petronet LNG will join in to talk about their Q4 performance. At 10 a.m., management of Fortis Healthcare will connect with us for their Q4 results. And towards the end of the show, we will connect with Rajiv Kaul of CMS Info Systems for their Q4 numbers as well.
Well, time for a quick break. We've got a lot of stock-specific action to track for you. We get at that in just a bit in our special Top 10 segment. For the time being, I give you a sneak peek into the list. United Spirits, Fortis Health, Aster DM, Dixon Tech, Torrent Pharma. All of them will be reacting to positive news flow out of the list. NHPC and Whirlpool. On the flip side, Gland Pharma, JK Tyre, as well as KPR Mills will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. You're still tuned into Bazaar Morning Call. Well, let's get going on all of our top 10 links. Our research team is standing by with the list of the top stocks that you need to track this morning. Well, Mangalam, let's start with you. United Spirits, is that keeping you in high spirits?
Not their products, but definitely their results in high spirits indeed. We've seen good performance coming from the Alcobev space this time around, and a large part of that can be attributed to the reopening of Andhra, and in that as well, there was, good expectations. The company has gone ahead and beat that too. Revenue, 3,031 crores. The street was working with the number a little over 2,950 crores. EBITDA, 460 crores. Again, beats expectations. Net profit, 421 crores. The street expectations were 310 crores. Partly boosted by higher other income as well. But nevertheless, it is a very strong performance. Why do I say that? Overall volume growth at 6.9%. Prestige and above, the key drivers of the company, have seen a volume growth of 9.2%. The street was working with a range of 8 to 10%, led by 13% revenue growth. Here as well, the street was working with a range of 12 to 14%. What's not done well is popular volumes that declined by 2.2% versus expectations of 3 to 5% growth. And out there, the revenues grew by 1% again versus expectations of 3 to 5%. But this, remember, is not the company's major focus area. They have said that growth has been driven by continued resilience of portfolio in a challenging consumer environment. Business, which commenced in Andhra Pradesh in September 2024 after a gap of 5 years, continues to do well for them. For now, I expect the stock to open in the green, but further gains or losses would be determined by what happens in the conference call, which is held tomorrow post-market at 4:30. So up until now, from what the numbers that we have, a fairly strong spirit.
Okay, all right. Thanks a lot for that, Mangalam. Well, Ekta, you go next. Tell us about, a couple of other names that did come out, Fortis as well as Aster DM.
Yes, both the hospital companies, they came out with its numbers post-markets. I'll start with Fortis, where the revenue growth was around 12% year-on-year. But what stood out to me was the margins, which improved to 21.7% versus 19.5% Q-on-Q and 21% on a year-on-year basis. So that is probably going to help the stock remain in the green. If you look at the segments, the hospital business was up around 14-odd%. Margins were stable at around 22%. Diagnostics revenue was okay, it was tepid, but the margins improved to around 20%. So I think I would be watching out for that. In terms of Aster DM, the revenue was up around 2.7%, but again, the margins improved to 19.2% versus 16.4% year-on-year and 18% sequentially. So that's probably one of the reasons why Aster DM would also probably be in the green today.
All right, you spoke about Aster DM and Fortis. In fact, the management of Fortis Healthcare will be with us today at 10 a.m. to talk about their fourth quarter numbers. But speaking about fourth quarter numbers, Upasana joins in. Upasana, Dixon Tech did not, surprise positively.
Good morning, Mangalam. Well, overall, if we see, the growth continued to be led by companies' mobile and EMS segment. Except mobile segment, company has reduced its revenue contribution in all the other three segments. Now, there is an exceptional item, that is a fair value gain of 250 crore due to the stake sale of Aditya Infotech this quarter around. Now, overall, if we look at the numbers as compared to our poll, the margin was a beat, while revenue and PAT was largely in line with our poll. Now, revenue saw an uptick of nearly about 1.2 times at 10,292 crores. EBITDA stood at 443 crores with an uptick of 1.4 times. EBITDA margin saw an uptick of 40 basis points at 4.3%, which was above our poll estimate of 3.8. And PAT, excluding the fair value change, stood at 215 crores, which saw an uptick of 67% on a YoY basis. Now, brokerages are indicating that there are signs of a demand slowdown and growth momentum of the company seen this quarter. So let's see how the stock pans out today. I expect it to open in green, but it might slip into the red.
Okay, all right. Thanks, Upasana, for that. We will be connecting with the management of Dixon Technologies at 9:30 a.m. today. But a couple of other stocks that I'm watching is Torrent Pharma. So I'll start with that. The revenue was up around 8-odd%. That was a little better than what the street was anticipating. Margins came in at around 32.6% versus estimates of around 32.9%, again in line with estimates, and a profit of around 498 odd crores, which missed estimates a tad bit. But the US markets did well. So US sales were around $35 million. The street was anticipating around $32 million. And in terms of expectations, the street is guiding, or the management is guiding, for mid-teen growth in terms of revenue in FY26. So maybe that could all augur well for Torrent Pharma. Separately, Gland, it was a miss on revenue and profits. The margins were lower on a Q-on-Q basis as well. It came in at around 24.4% versus 26%, and the profit came in below expectations. What didn't work for the company this time was the US business, which was down 10% year-on-year, India, which was a bit sluggish Q-on-Q as well as year-on-year, and rest of the world, which declined 16% Q-on-Q and 14% on a year-on-year basis. So just watch out for both of these stocks, Gland as well as Torrent Pharma. But separately, Vivek is here to tell us about NHPC.
Well, that's right. NHPC, a lot of one-offs in this particular quarter, and especially as far as FY25 is concerned, there's been a slight accounting change as well that the company has taken into account as per the new CERC norms. But overall, if you look at the quarter, it's been a good top-line uptick that the company has seen on a year-on-year basis. There have been very key projects that have been commissioned in April 2025, that's just post Q4, as well as when you're talking about the top line numbers, up almost 24.5% on a year-on-year basis. EBITDA down 5.4%, but EBITDA has multiple one-off items, key amongst them being this time around the interest figure was actually in the positive side. Now, along with that, when you're talking about the EBITDA margins, on account of that has been quite skewed at 46.5% on a year-on-year basis. But the profitability, taking into account the one-off items that has been seen, the core profitability has actually increased 57% on a year-on-year basis. Now, one important update that the company is given is that the company has taken into account 526 crore of unbilled revenue. This is as per the new CERC norms. And one key update is the fact that the company has gone ahead and commissioned the very important 800 megawatt Parbati to hydroelectric project in April 2025, and along with that, the Commissioner Solar Power Plant, one particular aspect or almost 107 megawatt out of the total 300 megawatt project has been commissioned there. Expect some green tick, but there is a call later today, and a lot of clarity needs to emerge, especially as far as the one-off items are concerned.
All right, Vivek, and you'll be getting all of that clarity. Thanks a lot for joining in and running us through, that analysis. But let's hop across to Sudarshan. He's here to tell us about JK Tyre. So take it away.
So it was an operationally weak quarter for JK Tyres. Both India and Mexico business have reported decline in EBITDA and margin. Overall revenue was up 2%. EBITDA has fallen 24% and margin too has fallen more than 300 basis points if you take a look at overall numbers. Talking about India business, which forms nearly 90% of its total revenue, their revenue was up 6%, but EBITDA has fallen 25% and margin too has come at 7.8% against 11%. Mexico business, which is very small, their revenue was down 27%, EBITDA is down 93% and margin has come, it was below 1% versus almost 5%. But more than Q4 FY20 numbers, what would be in focus is outlook, because internals for tyre industry have improved in last few months. So we'll be watching for that in the analyst call that's scheduled at 11:30 a.m.
All right. Sudarshan, thanks a lot for that. That's about JK Tyre. But Upasana, back to you on Whirlpool. Good numbers?
Yes, certainly. Now, if you look at the standalone revenue growth, it stands at 17% on a YoY basis at 1,890 crore, and company subsidiary revenue, that is its kitchen appliances business, Elica, the revenue growth here is down about 6% to 114 crore. This is likely due to the subdued consumer demand environment that we've seen. Now, if I look at the numbers on a consolidated basis, now revenue growth is strong, EBITDA margins have stood above the street estimates, while PAT is largely in line. Now, revenue uptick of 16% on consolidated basis, EBITDA stood at 183 crores, saw an uptick of 27%. EBITDA margins has seen an uptick of 80 basis points at 9.1% versus the street was estimating around 7.4% margin. PAT stood at 112 crore with an uptick of 42%, excluding the exceptional gain of 7 crore. So all in all, good set of numbers, and I expected the stock to open in green.
Okay, all right. Thanks a lot for that, Upasana. But Abhishek is with us and he's on top of most news. Abhishek, tell us about KPR Mills. What are you picking up?
Well, there might be a block in trade today. So sources tell CNBC-TV18 that there will be a block in KPR Mills. The stake on offer, that is the equity percentage size, is about 3.2% equity on offer. So the total offer size in terms of absolute value is about 1,195.6 crores. The sellers include KP Ramaswamy, KPD Sigamani, as well as P. Nataraj. So the floor price is at 1,107 per share, which is at a steep discount of 10% to yesterday's closing price. The sole broker to this issue is IIFL Capitals, and there is a lock-in of about 90 days post this stake sale for the existing investors to again sell their shares if they intend to. Back to you.
Right, Abhishek, thanks a lot for that. On that, we'll actually thank our entire team for bringing us up to speed with all the stocks as well. In case you missed it, here's a quick recap. Stocks with positive news flow are United Spirits, Fortis Healthcare, Aster DM Healthcare, Dixon Tech, Torrent Pharma, NHPC and Whirlpool India, while stocks with negative news flow are Gland Pharma, JK Tyre and KPR Mills. That's about the equity end of things. But for a round of all the action coming in from the commodities market overnight, Manisha joins in. Manisha, crude continues to boil.
Well, yes, we've seen some more gains coming in the overnight markets here, and it's trading nearly 1.5% up in the Asian market. Well, there have been reports of Israel preparing strike on Iran nuclear facilities. That clearly has added premium to prices. Iran, remember, is the third largest producer within the OPEC. And apart from that, we've also seen the U.S. crude stocks rise. The Kazakhstan production is up 2% on the month of May, so contradicting fundamentals. But at this point in time, it is about the geopolitics that is supporting crude. But not just crude. If you look at precious metals, industrial metals, all of that has gained in the overnight markets. Gold prices gained 2% overnight. Remember, the US dollar decline is something that is supporting the prices. Platinum gained 5%, silver gained 2% overnight. Copper prices are trading a percentage point higher in Asia right now. Palladium is up 3-month high. Tin is trading at a 1-month high as well. So it's a good start to the Asian market. The decline in US dollar and the geopolitical premium concerns are yet again leading to buying intangible commodities.
Okay, all right, Manisha, thanks very much for that. We'll take a short break on that note. But coming up next, we have the management of Belrise Industries joining in today as their 2,150 crore IPO opens today.
Welcome back. As promised, let's focus on the primary market action. Belrise Industries, they're looking to raise close to around 2,150 crores by the IPO route. And the issue opens for subscription today. It's going to be an entirely fresh issue. The company is looking to basically reduce their debt. To discuss more about the IPO offering, what kind of growth plans they have, what kind of peak revenues can they do, we have with us Mr. Srikanth, who's joining in the studio, as well as Mr. Sumit. Hi, gentlemen. Good morning.
Good morning.
Good to have you all in the studio. Well, you're looking to raise some money.
Yeah, that's right.
And most of that is going to be used for repaying debt. So let's get that basic question out of the way. What is the current debt on the books? And by how much of it does it come down? And because of this debt reduction, what is the rough interest cost saving? Please go ahead.
Perfect. So we're raising about 2150 crores in total. Our current debt stands at about 2600 crores. We are out of the 2150 crores. It's a completely fresh issue. All the money's coming into the company. Out of that, 75% is earmarked towards debt repayment and 25% towards general corporate purposes. So on a high level, 1600 plus crores, 1650 crores goes towards debt repayment. So that debt from 2600 comes down to about 1000 crores, significant sort of reduction. We're currently already at a debt to equity of under 1, and that will reduce significantly as soon as we pay down this debt.
So about 165 crores in finance cost savings, and you have roughly about a 120-130 crore bump up in PAT if you take out the tax impact immediately overnight.
Perfect.
What about growth going forward? You know, what we want to understand is what your current capacity utilization is, and what rate do you grow as compared to the two-wheeler industry? Because nearly 2/3 of your revenue come in at the two-wheeler industry, right? So is it 1.1 times, 1.5 times, 2 times? What should we equate your growth with versus the growth in the two-wheeler industry?
Let me answer it this way. So over the past 8 years, we've grown at a 11.5% CAGR, whereas the two-wheeler industry in terms of volume has only grown at a 1.4% CAGR. Okay. So as you obviously know, there was a period of COVID there as well. So we've sustained that growth despite that. And we've established a market leadership position in the two-wheeler industry with a 24% market share in the two-wheelers metal space, metal component space, which is a strong position to be in. We want to capitalize on this position and then grow in the four-wheeler and the commercial vehicle industry, because if you look at the total autocoms market size, about 3x of the two-wheeler industry is what the four-wheeler and CV industry sort of contributes. So that's our growth strategy there. And we've recently done 2 acquisitions to go forward on that growth trajectory.
Okay. Just wanted to touch upon the acquisition. H1 India is a recent acquisition that you've made. How much is it contributing in terms of your overall business? Is it profitable on the EBITDA as well as on the bottom line? And give us a sense in terms of what it brings to the table. I think it changes your mix when it comes to four-wheelers.
Correct, absolutely. So this company that we've acquired is a Japanese company. It was a wholly owned subsidiary of H1 Japan, a company called H1 India. They're global experts and specialists in high tensile strength manufacturing, metal manufacturing. What that means is you're reducing on a high level, say you're using sheet metal, you're reducing that from a 2 millimeter thickness to say a 1 millimeter thickness, while increasing strength and durability of the products. Yeah. So what that essentially allows us to do is, to answer your question first, EBITDA positive and PAT positive, so contributing to the bottom line. And in terms of growth opportunity, it allows us to now grow significantly in the four-wheeler industry, because going forward, the industry is going to demand high tensile strength manufacturing in terms of, from a standpoint of lightweighting as well as crash testing and reducing and from increased norms around safety.
Okay, all right. So, I'm a little intrigued with regard to the name, Belrise. You want to explain that to us?
Yeah, so earlier the name company was Belrise Engineering Limited. So Belrise Engineering, BEL and Rise. Okay. So Rise is perpetual. So we thought let us have a more.
We hope that Rise is perpetual for the shareholders now that you've come into the markets itself. But he spoke about diversifying away from two-wheelers. Two-wheelers currently account for 65% of your sales. From a strategy standpoint, how do you expect your revenue mix to move on over the next, say, 3 to 5 years as you increase your presence in four-wheelers and CVs?
See, we have done this acquisition of H1.
Yes.
H1 is a very, very crucial acquisition. They have a very unique technology which brings the thickness down by giving a higher strength.
Yes.
And which is in need of an hour currently. In the all four-wheelers, there is always a focus on reducing the weight. So I think with that strength in our hand, I think we will be able to be able to get good business from four-wheeler customers. And we will put our best efforts. How we have grown in two-wheelers for the last couple of years, I think we will demonstrate equal, strong dedication and commitment from our side.
As a percentage of your sales, where does that number go?
We can't disclose.
Where is it right now?
Currently...
So from a four-wheeler commercial vehicle perspective, it's about 12.5%. But we expect that to grow. We're not saying we're not going in the two-wheeler industry. We're going to grow in the two-wheeler industry. That is obviously a focus area, and we want to grow in the four-wheeler industry as well.
Not faster.
So
2x that of the two-wheeler?
I wouldn't want to comment on a number. But fundamentally, because the base is lower, we're able to grow a little faster in the four-wheeler industry. But two-wheeler industry remains a focus. We work with pretty much every single OEM in the space. We want to continue working with them, and they're our prime customers still.
The other segment which is, not contributing as much as your exports, I think it's around 3 to 4% of your sales. What's the plan on that?
Till now, we are busy into domestic customers. We're focusing on that. And maybe I have now two sons, both joining with me. Sumedh has done an MBA from Harvard Business School, who is my elder son. And my younger son, Swastit, he has done his graduation from Wharton, dual degree. Then he was in McKinsey in Chicago for 1.5 years. So both have joined me in my business. And I think the bandwidth of the management has definitely gone up.
So that means the exports will increase as well?
Of course.
Bandwidth and the network because of the US education, I guess.
Perfect. So we'll focus domestically also on exports also. So export percentage, definitely you'll see in coming.
To what? What are you comfortable?
We can't comment on numbers. We will put our best efforts.
All right. So sir, what works for you, I think, is all the money that you're raising comes back to the company, which is good.
It's all primary.
Generating good amount of operating cash flows, which is good also. And as you highlighted, both the sons joining in. So the street likes those kind of things, right? When the succession plan, everyone, and as you said, good amount of pedigree. Couple of questions here. Last year, you did close to 7,500 crores, I think, of revenues. Sure. Very, very roughly.
Correct.
I think Mangalam asked you that earlier as well, but what is the peak revenue potential given the inorganic growth? The regulators watching, I know.
Yeah.
But perfectly in line with that, the peak revenue potential, what is it, with the current capacity that you have and with the inorganic growth? Please go ahead.
Let me answer it from a capacity utilization perspective.
Okay.
So usually in the automotive industry, how it works is I have to set up a certain capacity, invite a customer, saying, see, this is what I have available for you, and give me more business. From an automotive manufacturing industry perspective, a 60 to 70% capacity utilization is a decent capacity utilization, and we're currently at satisfactory levels. We see there is some headroom for growth, and we should be able to capitalize on that with the IPO, which has very solid sort of anchor participation, but I'll leave that to you.
So 65% last year, that's 7,500 crores equates to around 65%. Is that the rough?
We can't.
So you can.
I'll tell you why it is. So
what I'm trying to get at is, what kind of a growth potential do you have from here on? Do you have to add capacity, or is the current capacity good enough to grow, say, by mid-teens for the next few years? Is that possible? Sure. And also, do you have any levers on the margin front? Because you're doing that early teens, 12, 13% approximately of margins. Are there any kind of kickers that you have that you can, push up that margin number?
Correct. So from a capacity utilization perspective, see, our products are fundamentally, or our machinery and equipment is fundamentally fungible. So we have press machines, we have surface treatment, so that we can use for two-wheelers, three-wheelers, pass cars, commercial vehicles, or any other sort of manufacturing process per se. So inherently, that is fungible, so we can move between products. Obviously, for the special purpose machines or for a model-specific machinery, you have to do that kind of CapEx. So there'll be a certain CapEx, but we want to also leverage on our current CapEx that we have.
And it all sounds, very positive in terms of the IPO. But if you had to list down probably one of your biggest threats going into FY26, FY27, considering that you have so much domestic market exposure, what do you think is the biggest challenge for the company that investors need to know about?
So, from a threat perspective, we've grown at a. I wouldn't say it's a threat. It's about for us to be able to deliver on our past track record, and we believe we can do that. So I think we're in a good spot to be able to capitalize on that.
Skill level is always a need of an hour, and I think as we become diverse, multiple locations, multiple customers, I think I always say you need to replicate your clones who will match your commitment and your dedication towards customer. I may give my best, but my team should also match that. So making more clones.
We keep pressing for numbers. I think the one thing that I'll watch out for going forward is the increased content per vehicle from your end. If you could give us a sense on how that has grown, because 1.4% volume growth over the last 10, 11 years, your revenues have grown nearly 10 times of that. What has the rise in increase per content per vehicle been for you, and how is that likely to go forward?
So value addition per vehicle has gone up for us. So earlier we were doing the components like frames. We are not doing surface treatment. So we started doing surface treatment. That is the valuation that we do.
Yes, or if you can give an absolute number,
Surface treatment, then there is the ED coating is there, then there's for the sub-assembly is there. So at multiple levels, we are adding a process which is giving to a higher valuation.
I'll add to that. So, see, our strategy there is to work on multiple different products, work on increasing content per vehicle, and also focus on the premium segment where your content per vehicle automatically increases. So the same part that goes into a commuter segment would say cost 100 rupees. Now when it goes to the premium segment would be close to 200 rupees. So that is the lever that we can pull, and we're currently, that's our focus area for growth.
All right, gentlemen, we appreciate you coming down. You've given us a brief understanding about the company. We wish you all the best for the issue, and on listing, we re-invite you all on, and at that point of time, we'll push you all a little bit for the numbers.
Sounds good.
Thanks a lot for joining in.
Perfect.
Thank you. Thank you very much.
Well, on that note, though, we'll have to slip into a short break. Come back. Deven Choksi is waiting for us on the other side. We'll get some fundamental stock analysis going. Don't go anywhere.
Welcome back. You're watching us here on Bazaar Morning Call on CNBC-TV18. In case you've just tuned in, the overnight cues from Wall Street slightly soft, but the GIFT Nifty is indicating a 15-point uptick after a big gash that we saw in yesterday's trading session, particularly in the mid and small cap end of things. We welcome Deven Choksi from DR Choksi FinServe. Deven, good morning. There was a big cut yesterday, but moments before we came to you, we were having this conversation with the management of Belrise. The IPO season seems to be picking up. There are a couple of press conferences for IPOs lined up in the next few days as well, including that of Hotel Leela. Amidst all that is happening right now, have you had a chance to look at this offering, and what's your sense on Belrise and the auto ancillary space in general?
Yes, good morning, Mangalam. Well, I believe that I think Belrise appears to be a promising company. Given the kind of product range that they are catering to, both for ICE engine as well as for the EV, in respective categories, be it two-wheelers, be it four-wheelers. I think they have got probably a good amount of lever as far as the ability to maneuver the product range from one end to another end is concerned. That's what we gather from the subject understanding of the company. More importantly, this particular money which they are raising is getting utilized for the purpose of debt repayment, which means that if you take balance sheet fast forward, I think for next full year, probably, I think the amount of saving that they would have in the business because of the cost of interest, etc., will significantly enhance their profits going forward in the next financial year. So that is a promise which I believe that I think is likely to pay well in the marketplace. As such, we remain positive about the prospects of the auto ancillary companies, largely because of the fact that the India adoption of most of the global vehicles is happening at a faster pace, and including in EV space, I think this is happening now. So to a greater extent, the ancillary companies are likely to see the major benefit going into the groups. So selective companies in the portfolio, I think we remain bullish about their prospects. Of course, the valuation at current level appears to be slightly expensive for this company. But as I said, that I think if they end up saving money on the interest cost and end up, I think, adding to the bottom line, which they could, in such situation, I think the valuation could get rationalized, a little bit expensive at the current levels.
Okay. Deven, hi. Welcome to the show. Morning. Wanted your thoughts on IndusInd Bank. It's coming out with numbers today. What are you expecting in terms of commentary, which I think would be the most important to watch for?
Yeah, good morning. Well, I think the most important part would be that they are going to be announcing probably as to what kind of efforts it would take for them to clean up the balance sheet. Already the major numbers are known of close to around 2,700 crores, which they probably had taken a significant amount of the damage into the balance sheet. In my viewpoint, I think how the corrective actions would take place, there probably the eyes would be what kind of management changes and what kind of team building that will be happening. I think that's where I think people will be keeping an eyes on. But as I see it, I think for next 1.5 to 2 years, I think major efforts will go in repairing the balance sheet as I see it at this point of time. So frankly, from investment perspective, would like to seek more clarity before taking any view on the subject.
Do you have a chance to look at the results that came in from Dixon as well as United Spirits overnight? United Spirits actually beat street expectations. Dixon, while it did beat street expectations, there are signs of a slowdown in a couple of their segments with some uncertainty around manufacturing going forward as well. Your thoughts on both of them?
So Dixon, the numbers are on the profitability front, that is the margin front, I think they appear to be relatively more stable than in the previous quarters. So that's a good sign. But whether it's something which is an opportunity, I'm not too sure. Everything is in price. They're getting this kind of fancy valuations. Even though they have a higher amount of growth and growth programs undertaken, I don't think that I think easy to accept that in this kind of valuation. So maybe we'll have to wait for corrections of any degree, maybe price correction or all the time corrections to get into such kind of businesses when they're expensive.
And United Spirits?
Not too sure about that number, so haven't looked into it.
Okay. Oh, what about Hindalco? Did you have a look at Hindalco and what it reported in terms of its India business? It did well. Net debt is looking better.
So overall numbers, I think they are definitely appealing. They are better than what all expectations were. And certainly, I think the forward outlook, I think, from the company is appearing more promising than before. As such, I think we believe that it is time for some of the metal commodity companies, the ferrous and non-ferrous. I would think that next 6 months to 1 year, we are likely to see on one side the higher amount of global output emerging from metal commodities, and on the other side, for companies in India particularly, where they are having the advantage of lower input cost, lower manufacturing cost because of the energy cost prices are under control and they are mixing the renewable energy. So in my viewpoint, the profitability on one side and the market conditions improving on the other side, they are very well for many of the metal commodity companies. And that's where probably I think one could see the direction on the positive side. Once again, maybe some small corrections here and there, but I think the opportunity appears to be opening up for a big upside going forward.
Did you look at NHPC's numbers? I mean, some of their key projects have been commissioned in April as well. So post the Q4 numbers as well, the outlook seems fairly strong. The EBITDA was lower because of a couple of one-offs. So if there is a decline in today's trading session, would you look at increasing exposure to NHPC?
Not too sure, Mangalam. I haven't thought in that direction whether I would be considering this particular company from investment point of view. Maybe certain amount of reservations on this kind of businesses. That's where probably I think we are not completely applied our mind on taking them into investment portfolios.
And what about Eternal? Because that stock ended at the low point of trade yesterday, was 4% lower. It's that liquidity event which is likely to happen here, which is possible exclusion from the MSCI index, and that would lead to about $1 billion worth outflow because of the passive outflows. Because the company is recognized itself as a domestic-owned company, shareholders have given that note as well. Would you look at this dip as a buying opportunity, or do you think concerns around quick commerce will continue to plague the balance sheet of the company?
Yeah, we have reservations on the business model per se, and I think we feel that in the quick commerce game, probably the Reliance JioMart is basically putting in significant amount of efforts to probably meet the competition and beat the competition. So maybe I think one would not like to immediately buy into the companies which are relatively expensively quoted at this point of time. Yes, I think they have been trying to overcome this situation by way of adding different revenue streams into the portfolio. But in my viewpoint, I think they're still expensively quoted. So we'll stay away from it because the larger players are going to put significantly big amount of money behind the business. And that's where I think this kind of companies may remain a little vulnerable. I think unless they raise more money, they will remain a little more vulnerable.
Well, Devin, more of a short-term question, and I don't know if you're probably getting some client queries on it, but given this little bit of caution which is emerging with regards to COVID-19 cases, are you seeing a lot of queries probably come in for hospitals as well as diagnostic stocks?
Not yet. I don't think that. I think that is coming on the surface immediately, but maybe I think one will have to keep an eye on.
Okay. In general, how would you approach, say, a Fortis and an Aster that came out with its numbers on the hospital space? Any of these stocks that you've looked at?
Yes, we keep on having a good look at these companies, but we feel that most of the things are in the price. They are not the attractive proposition at all. every company is talking about growth, adding number of beds, new facilities, etc. But the fact remains that I think they are leveraging on the market cap value that they are having, and they are probably, I think, rightfully doing so. But at the same time, for investors, I think they remain expensive proposition. So unless we see some meaningful price correction for at least, I think, seeing the headroom up to 20-25%, one would not like to buy into at current price. Maybe wait for some more time actually.
All right, Devin, thank you so much for joining in and giving us your views on a whole host of stocks and sectors. With that, we'll take a short break, come back on the other side. We have the pre-opening rates, and alongside that, we have the management of Nazara Tech joining in as well. We'll also get you technical ideas from Sudarshan Sukhani and Shilpa Rao. Nitesh Mithasen joins in to discuss their latest acquisition and investments.
Welcome back. Well, this is the Open Exchange live from the CNBC-TV18 Motilal Oswal studio. Well, let's get talking about a couple of technical calls that you need before market opens. Sudarshan Sukhani and Shilpa Rao join in for their check on the market today. Sudarshan, Shilpa, welcome to the show. Well, Sudarshan, I'll start with you. What's your call in terms of where the Nifty could head today, considering that it has been cautious for the past 3 trading sessions?
Yeah, good morning. Well, yesterday was a disappointment. The idea yesterday was that we had a 2-day dip and perhaps we should be going long. And that exactly turned out to be the opposite. So once the market breaks support levels, I mean, by the market, I mean the Nifty, it becomes very difficult to suggest what the next trade will be. Today, we don't have a clarity on the short-term trend. Are we sideways? Are we up? Or are we heading down? So with a complete absence of clarity, my suggestion would be avoid the Nifty completely today. Let the market decide whether it at all finds support, whether it is willing to go higher. If we have to buy it tomorrow at a higher level, that's much better than entering today in a sort of a puzzle of confusion. So the Nifty is an avoid. The Bank Nifty still has a long opportunity going and buying the Bank Nifty with a tight stop around 54,500.
All right, and Shilpa, your calls on the index?
Good morning. My call would be, probably a wait and watch scenario. But if you're a compulsive trader, then, the support of 24,700 should act likely a brief, support zones as of now. So if it holds there, then maybe 100 to 150 points on the upside cannot be ruled out. And you can see 24,900 to 25,000 zones again hitting there. Bank Nifty, again, with a stop loss of, 54,700, you can still attempt a long there. And if there is some sort of consolidation or some sort of, pullback happening today, then you'll see 55,500 levels coming in again.
Okay. And Sudarshan, stocks today?
Well, the Nifty is uncertain, but the stocks are still on the long side because the market hasn't turned yet, at least it may not turn. So Sun TV is a buy with a stop under 627. Dabur from the FMCG pack is a buying opportunity with a stop under 467. FMCG has been in my list yesterday also, so there is something going on hopefully in that sector. NTPC is a buy with a stop under 335. And Lal Patlab is again a buying opportunity with a stop under 2770. It's an all buy list for small and mid caps.
All right, Shilpa, your stock picks?
I will have one buy. The buy would be in Coal India. Coal India, despite the fall yesterday in the market, we saw some sort of strong consolidation happening and it was holding well. So with a stop loss of 400 from here, keep holding Coal India. It should do 430 to 440 zones from here. The other one would be a sell. Sell would be an Indian Hotel. Indian Hotel has broken down some crucial levels of 780. So with a stop loss of 780, keep a sell target there for 720 zones from here. The other one would be a buy in Muthoot Finance. It has seen some substantial correction yesterday, but 2000 levels continue to be a support. So if it holds that, then levels of 2100 and above can be seen.
Okay, all right, Shilpa as well as Sudarshan, thanks very much for joining in and giving us all of your pre-market calls. Well, let's talk about Nazara Technologies. The stock's been buzzing this month with nearly 30% gains. The company is on an expansion spree as well. They've interestingly acquired UK-based Curve Games for around 247 crores, while their subsidiary Fusebox Games has partnered with Banijay Rights. To discuss all of these developments, we have with us Nitesh Mitterson, who's the Joint MD and CEO at Nazara Technologies, joining in. Nitesh, hi, morning, welcome to the show. Well, let's start with, the reason why you've purchased Curve Games, which is you've shelled out around 247 odd crores. If you look at the numbers, the revenue has actually been declining for the company in CY24, CY23. So what's the reason for that?
Sure. As you know, our stated objective has to be double down on the core gaming business that we have. And we have been expanding globally through these acquisitions of gaming studios and publishing houses. I think we found Curve very interesting because it's a very reputed firm in the PC and console publishing space. And the PC and console publishing space globally is a $100 billion business. And we also see a lot of synergies between our mobile gaming business and the PC and console gaming business. So it was very attractive for us. But the valuation we got was very attractive. I think the decline you see is largely due to post-COVID normalization and a few other issues. But we believe that much of the pain is behind us. If you actually look at the EBITDA numbers and the PBT numbers, they have improved over the last 2-3 years. So we believe we've got a company that can grow well in the future and add a lot of synergies and business to us.
Right. That's a fair point because while you bought it at one-time sales, trailing sales, your EBITDA is roughly 35-40% is the margin that the company operates on. So that's a positive. But I wanted to understand what proportion of this revenue is recurring on account of the games that they have developed already, and what's the publishing pipeline that you have out here? What can this scale to?
They have a very strong back catalog and some very popular IPs such as For the King and Human Falls Flag, which have been running and monetizing for many years. So we believe there is underlying stability in the business. And on the top of it, the company, as a publisher, they are working with developers on a continuous basis. Now that Nazara has stepped in, we will accelerate that process and ensure that there's an even stronger pipeline going forward. One more big synergy is that India is seeing, mushrooming large number of PC gaming developers due to the fact that Nazara is very embedded into the Indian ecosystem. We are usually in good contact and relation with all these Indian developers. And I think we can create this entire very exciting bridge between Curve partnering with Indian developers and building a strong publishing pipeline globally.
So what does this do to your blended margins, this particular acquisition?
Sorry, the overall margins?
Yes, your blended margins.
I think it's a little early to say. It'll obviously have a significant uptick on our margins, but we'll just let it play out in the next quarter or so.
And what's the scale that you're looking at here from, say, this roughly 25 million pounds outlook annually? How much can your acquisition scale this business up to?
Usually we'd like to see the first year the business stabilize. We focus on long-term growth and take the right decisions. But I think 2-3 years out, this business should be, compounding at least at a 15-20% year-on-year kind of metric.
Okay. You also announced, before we get to that global launch of Big Brother, before we talk about that, I just wanted to understand how you, paying for this particular acquisition, what does it leave you with in terms of the balance sheet, and what might your pipeline of M&A now be?
Sure. So we're paying about 240 crores for this, 247 crores for this. It's from internal accruals that we have. Cash is 100% cash transaction. Post this, we will have about 200 crores of cash with us. In addition to that, as you know, we had done a preferential placement of 495 crores, and we expect that money to come in the next month or so. So I think including that, we will have about 700 crores of cash on our balance sheet. We will continue to look at opportunities throughout this year and double down wherever we can, only on the gaming business, especially global gaming studios.
All right. 700 crores comes in, no real problem for cash for you. You are M&A heavy anyway. Just wanted to understand now to what Ekta was asking about, the global launch of the Big Brother. If you could give us a sense of what the revenue share here is, how does that aid your overall performance in the gaming vertical?
Sure. This is, launched through the Fusebox Studios in the UK, which we had acquired last year.
Yes.
We own 100% of that studio. They already have a very popular game in Love Island, and this is the next game that they have launched. Big Brother is a global franchise. We've also acquired rights for Big Boss in India, which we will launch in the next 2-3 months. So we think this should do very well for us. It's early days. The game has just launched yesterday, but early signs seem very promising. We usually pay the license holders somewhere between 15-20% of net revenues after user acquisition spends. That's a general template when we are working with third-party IPs.
So how much will it add in terms of your P&L? If you could just break it down for us.
Yeah, it's early to say because, games can take off at different scales. So it's very difficult to predict a number. But if you look at Love Island game from Fusebox, that has been generating about 200 crores a year in revenue, doing about 40-50 crores of EBITDA. We'd love to see Big Brother kind of, repeat that. But we'll have to see how it goes.
What about Big Boss? Because while there is a fair amount of viewership for that show,
yes,
I'm not sure how that translates into game and net revenue for you on that. Similar is the case with Big Brother as well, because if you could, say, give us correlations between Love Island and the game in terms of viewership and the conversion to game revenue, and whether that is likely to replicate in Big Boss and Big Brother as well.
Big Brother, I think globally, because it's a popular franchise, Love Island in the Western markets should monetize well for us. Big Boss obviously is a target to the Indian market. We are, having 7-8 languages that we are launching in. And India is a strategic market for us, right? We want a large user base, even if it monetizes a bit lower than the global markets. So we are okay with that, but we'll see how it goes.
Okay. What's the pipeline of more such tie-ups and how much are you willing to shell out on those?
Yes, of course. In recent times, we, for example, in Kidopia, which is another flagship product of ours, children, we've done many IP licensing transactions, including Barbie from Mattel, etc. So we're seeing a lot of, opportunity where we can take global IP, integrate them in our games, and then launch these games globally. This monetizes well. It helps us overcome the challenges of, user acquisition, which we have discussed many times in the past. So it's a path that we are on, and I think it will pay good dividends to us.
And since we have you with us, if you could give us an overall outlook on all the verticals of your company for the next year or so.
Sure. Of course, results are due soon. So
yes.
I won't go into specific numbers, but we have, our esports business, which continues to do fairly well. Our core gaming business with higher margins is doing well for us, and some of these acquisitions are focused on it. So I think overall, we are on a good growth track for this year.
Okay, all right. Thanks very much for joining in and giving us all of that perspective on Nazara Technologies. So, big acquisition of over 200 odd crores is what they've made in the UK. Quickly, then, Sudarshan, coming back to you, what's your 9-10 call?
But that's NTPC. Buy NTPC with a stop under 335.
All right, Sudarshan, thanks a lot for that. I wonder how United Spirits will play out in today's trading session. In the pre-open, it had seen a big uptick. Let's see whether that sustains in the open or not as well. In fact, the pre-open uptick itself hasn't sustained. But be that as it may, it's a good performance that the company has reported. The revenue as well as the EBITDA have beat street expectations by a wide margin for the EBITDA, and the net profit as well, further boosted by other income. The Prestige and above volume growth at 9.2%. In line with good expectations of 8 to 10% growth out there. Revenue growth of 18%, again in line of 12 to 14% expectations there. What did not do well was the popular business, which saw volume decline of 2.2% versus an expectation of 3.5% growth. But that is not a focus area for the company as well. They've said that there has been a challenging consumer environment, in that there has been resilience of their portfolio. Business in Andhra Pradesh led to the growth coming by in their P&A volumes, which is something that we saw across the board in the Alco-Bev space. The con call tomorrow at 4:30. We'll get more details from that on the leadership strategy. But for now, opens mildly in the green as per what the pre-open is indicating. But that's about Daru. Ekta, what about Dawa? Torrent Pharma.
All right. Well, for Torrent Pharma, the revenue is up around 8 odd %. It is, a stand better than what the street was anticipating. 2,959 crores is what they reported, and the estimate was 2,904 crores. EBITDA 964 crores is what they've reported, and versus estimates of around 956 odd crores, which resulted in a margin which was in line at 32.6% and profit of around 498 odd crores. Now, what stood out was that the India business was up around 12% year on year. It was led by the chronic segment for Torrent Pharma. India was up around 12 odd percent. US sales were a little better than estimates. So US sales came in at $35 million versus estimates of $32 million. And the management is expecting mid-teen revenue growth in FY26 versus what the street is working with of around 9.5 odd percent. Brokerages, Nomura has written on it, neutral, target price 3,580, except for the US revenue across geographies was behind estimates according to them. Citi, buy with a target price of 4,000. Margins at 33% was up 60 basis points Q on Q versus a guidance of flattish margins. They believe the margin expansion trend will continue. Nomura has a buy and a target price of around 3,760. So let's see what Torrent reports. Let's go across to Sudarshan. I think he's watching JK Tyre.
So in pre-opening session, the stock is down more than 2%. It's on the back of operationally weak Q4 that company has reported. Both India business and Mexico have seen a decline, both EBITDA and margin. If you talk about the overall EBITDA, it was down 24%. Margin has fallen to 9.7% against 13%. India business, which forms nearly 90% of total revenue, their margin has fallen to 7.8% from 11%, and EBITDA was down 25%. Mexico business, which is very small, there also revenue was down 27%. EBITDA has fallen 93%, and margin has come below 1% against 5% in the same quarter last year. But more than the Q4 numbers, what would be in focus is the internals have improved for the tire industry in the last few months. So we'll have to watch out for in the analyst call what exactly company says about the outlook going forward, especially about Q1 FY25.
Okay, all right, Sudarshan, thanks very much for that. So that's JK Tyre. But I'm looking at Zydus Life. So it came out with its numbers yesterday, but the commentary seemed positive. It came out with numbers during market hours, but the management commentary was positive. So let's see what the stock does. They expect single-digit growth in the US revenues in FY26. This is despite a high base of FY25. For example, they had Revlimid generic, Mybetriq generic, Asacol HT generic. They are expected to continue selling Mybetriq in the US despite the recent patent litigation. So that's something that Lupin had also indicated, that they will be looking at, some kind of legal add-ons when it comes to this. Large US launches like Adempas generic as well as Ibrance is expected to add in FY27 and FY28. They're guiding for EBITDA margins of around 26% plus in FY26. So let's see whether that comes through. That would probably be something that the street is watching out for. It would be lower than what they did in FY25. But the US business, the fact that they can sell Mybetriq generic, continued sales of that, and this is when Revlimid generic is sort of weaning off for most of the companies, should probably go down as a positive, guys.
All right, we look at how the street takes that on Zydus Life. But for the market opening, 60-point uptick is what the pre-open has settled at right now. The mid-caps a tad lower in terms of comparison with the frontline index. But we'll keep an eye out on how it pans out from an index level. A couple of individual stocks actually really stand out. We have NHPC, which is among the top F&O gainers this morning, up around 2.64%. Results are good. Profits rose about 57%. We're also seeing some traction in a name like Siemens, which is up around 2%. DLF up about 1.5%. On the way down, though, we do have Supreme Industries and GMR Airports down about 3% and 1%. In the broader markets, a stock that really stands out in terms of gains with decent volumes backing it is Dredging Corp, up around 11%. So let's see whether that sustains again once we open or not. But by and large, looks like a fairly stable opening, pretty in line with what the GIFT Nifty was indicating. We have about 3 seconds to go. So the bell rings.
Well, that's right. 60-point uptick is what we are seeing. But I guess, the markets could be a little bit nervous. So at some point of time, that could get sold into. For the time being, good green, 70 points higher. Coal India is up close to 100%. BEL as well as returned to its winning ways. That's up close to 100%. Dr. Reddy's, that's up 1.5%. So good move is what we're seeing on that name as well. What's dragging? Trent is down mildly lower. It's down close to around 0.5% or thereabouts. Trent as well is down. Eternal is seeing another downtick of close to around 0.5%. The mid-cap index, as we speak, that moves into the red. Yes, the mid-cap index has now done a bit of a U-turn as we speak. Number of stocks advancing still around 1,000. The number of stocks declining, they've crept up to around 600 number of stocks. KPR Mill, we're expecting a large trade out there. The stock is down close to around 5.5%. Kochi Shipyard pausing for breath. Stock is down close to around 2.5%. Ircon, though, is up close to 2%. And Vivek told us that NHPC as well, those numbers were quite good. So that one's up close to around 2.5%. Hindalco, the numbers look quite good. For the time being, the stock is holding with a gain of around 1%. Investec and some other brokerages, they're pointing out that maybe, in fact, the past quarter was peak performance. But for the time being, the stock's building on gains up 1%.
In the mid-cap end of things, I'm looking at a couple of stocks, Nigel. Whirlpool, that is top of the pops this morning, up around 6%. Good numbers coming in. Upasna did tell us that margins increased by 80 basis points. EBITDA up by 27% as well. Seasonally strong quarter for them. That stock is up 6%. We are also looking at Dixon Tech, though. Despite good numbers, stock's seen a bit of a sell-off, down about 5%. Right now is among the top losers in the F&O space today. And giving a company on the way down is PI Industries as well. PI Industries is another one which is down 4%. Surprised by the move that we're seeing on United Spirits, though. The results weren't bad. They were good results. The stock opened in the green, and from there itself, it's seen a sharp sell-off, down about 3% right now. It will be very interesting to see whether it is on account of valuations, it's on account of the street awaiting clarity coming in from the conference call or not. But right now, swift profit booking is what we're seeing on United Spirits. Delivery, Gale are the other ones which are lower. Torrent Pharma, Ekta spoke about it. Good numbers, stock up about 1.5%. And we spotted dredging the pre-open. Actually, post-open, that up move continues. Dredging is up 10% as we speak, with decent volumes backing that stock as well. Ekta.
Okay, yes, absolutely. I think Whirlpool and NHPC are really the big stocks of today. But I just want to point out, without adding too much of drama to it, but a couple of these diagnostic stocks are higher. So Metropolis is, in the green. We have Thyrocare, which is up around 2.8%. Maybe there could be a little bit of incremental testing which could take place because of COVID-19, and that is possibly reflecting in terms of the stock performance at this point in time. Separately, JK Tyres, just watch out for that because that stock is lower post its numbers, so it's down around 2.7%. You have Dixon Technologies, which is down around 4% at this point. Pfizer, which was up around 11% yesterday post numbers, is showing some amount of profit booking today. So that stock is down around 1.7%. You were talking about, a couple of these AC makers. Blue Star is showing some amount of traction on the upside. And just watch out for Aster DM, Fortis. Both these stocks are moving in opposite directions as we speak in opening trade. But
all right, just a few more stocks I wanted to highlight. Finiotex Chemicals, the stock has got smacked. It's down close to around 8.5%. So big downtick is what we're seeing out there. Sangvi Movers, that's the other one that's down close to around 5%. In the last few trading sessions, the stock had run up very, very hard. But now, in fact, it's coming for profit taking. So that's another result reaction. Finiotex Chemicals. You have Sangvi Movers as well that's coming for some profit taking. And Arvind Smart Spaces, that stock as well has seen some mild profit taking as we speak. So just keep an eye out on that one. In terms of Whirlpool, the reason that the stock is up, I think the margins that they delivered was the best that we have seen all the way since Q4 FY21. And this is even after they saw some kind of gross margin compression. So that's why the street likes it. That's why the stock is up close to around 5%. I think in the last 45 days or so, the stock actually is up close to 35%. So big move is what we're seeing. Valuation support is what is there in comparison to its past. And also you see the margins that are perking up, though the overhang with regard to what the promoter entity will do, that will continue. On Dixon, I'm going through a note, that's come in. There is a bit of a downgrade that's come in from GM Financial as well. They have downgraded the stock because the stock is valuation-wise not very, very cheap is what they're highlighting. They've trimmed their guidance as well. EPS cut of around 6 to around 7% or there on terms of an EPS cut. So even after good numbers, no valuation comfort. So the stock is selling off.
Just looking at Solar Industries, yesterday in the last hour of trade, we had some commentary coming in from the management con call out there. And this morning, it's done well. The stock was at a near record high a few days ago itself. But after there were the numbers, the management gave good commentary and the stock has recovered about 4% from lows and currently at the high point of trade.
Okay, so just about consolidating for the indices as we speak though. Nifty is up around 48 odd points. The mid-cap index is just about flat with a little bit of a positive bias. Let's get talking about a couple of cues for the markets. We have Nimesh Chandan, who is the Chief Investment Officer at Bajaj Finserv Asset Management, who is joining in now. Nimesh, hi, welcome to the show. Thank you very much for taking the time out. If you could just start with your overall call for the markets, just about consolidating today. We had a large FII sell figure yesterday. What is your take? Is it more stock specific? Are we going to see consolidation in the frontline indices to continue?
Good morning and happy to be on your show. We are quite bullish. So while there is volatility expected in the near term based on certain headlines that come, certain numbers that come of the previous quarter, actually, fundamentally, India is actually positioned very well for this year. There are many positives that have come up in the last 4 months, which actually strengthen this up move and possibly can continue this bull market. We've seen fiscal policy being more demand-oriented, and you will start seeing that reflected in generally savings and consumption growth in the coming year. We've seen accommodative monetary policy with 2 rate cuts already come in and 2 more expected. So lower interest rates, better liquidity, better credit growth will start showing up, and it will impact BFSI positively. It will impact consumption positively. Even in the trade talks, if you see the worst case scenarios didn't turn up, and India actually benefited from some of these trade talks, and possibly we have another agreement to be signed with US also. And trade is a relative game. So if your neighbors are being taxed more and you are at a lower tax rate, then it's fine. So a lot of positives that have come up in the last few months. I think markets are reacting to that. Yes, some volatility based on international headlines as markets stabilize will come in, but very positive outlook for India, especially the large cap space and selectively in mid caps and small caps.
So what is your positioning right now when it comes to sectors, Nimesh? And based on your investment philosophy, what are some of the things that seem attractive to you beyond the financials and consumption names that you just spoke about? If you could get a little more specific.
I'll just give a perspective and try to slice and dice our portfolios in various categories of segments. Let's say if we've been accumulating mid cap and small cap in the last 2 months, and we've increased allocation there. We have increased companies with a combination of quality and growth as a factor because they give you upside as well as they are a bit defensive. On the third, if you cut by themes or sectors, we are positive on BFSI, consumption, and healthcare. Within BFSI, NBFCs will see immediately the benefit of lower costs, and we believe that rest of the year you will see good credit growth helping the banks. In terms of consumption, we are bullish from everything from groceries to real estate, and especially certain segments like alcohol beverages, real estate, and ancillary, say, plays to real estate, we are quite positive on. And healthcare, we believe that after some clarity on this US tariff, valuations will get back to normal because there's a huge runway for growth for generics. Indian markets, in terms of pharma, diagnostics, hospitals are giving you a steady growth and the numbers are good. And CRAMS and CDMOs, I think this is one segment which will see a very good growth in the next 3 years.
All right. Hi, Nimesh. Good morning and good to see you. When, just to sort out a couple of details, earnings were not expected to be that great for the past quarter. And I think, most estimates, they are indicating that maybe, in fact, it's a little bit better than those weak estimates. However, FY26 is going to be the big year because we need to get back to that mid-teen double-digit growth. What are the odds? How do you read last quarter's earnings and your expectations for this year?
Good morning, Nigel. Actually, you see from the first quarter end of last year, so from Q1 FY25 end, we've been seeing downgrades in numbers and people have been reducing their estimate because outlook was a bit slow. You saw the pickup in GDP also coming in the second half. In the first half, we had a slow growth almost throughout the economy. Now we are probably out of this worst phase where we were seeing some downgrades. Right now, also when we see the numbers on reduced expectation, I think now everything is even Steven in terms of beats and misses. Yeah, you have to be selective in each sector to pick up the right companies. But it looks like that the downgrades, that cycle that we were in, seems to be now at a pause. From here on, if I listen to all the conference calls in various sectors, one noticeable thing is every major sector leader, every large cap company in the sector is looking for a better FY26 than FY25. And except maybe some sectors which are internationally exposed and they see uncertainty, like for example, the IT sector. Most other sectors, if you see the commentary of market leaders in those segments, they are guiding for a better FY26 than FY25. We have to choose on valuations where large caps right now look very attractive. Mid caps, small caps, in pockets, they have become attractive after the correction.
Okay, fair enough. Nimesh, you did mention CDMO players in the pharmaceutical space that you would be looking out for. We have this entire semaglutide opportunity which is going to emerge in next year. And that could be probably a big positive for a lot of pharma companies and ancillary companies within that space. Is that an opportunity that you've looked at, and how would you play it?
Absolutely. So if I look at the numbers that are projected till 2030 and 35 of GLP-1 molecules, and obviously their derivatives and other modes of delivery, I think there is a huge opportunity there, and Indian companies have the expertise to take benefit of this, whether it is supplying on the CDMO side or competing on the generic side. So I think this is a big opportunity for pharmaceuticals in India. We obviously have to go company by company in terms of what major impact they will make on the revenue of that company. But I think this is a very long story to go. I mean, next 5-7 years. See, some of these CDMO stories and GLP-1 stories, investors have to look at the mega trends and be a little patient with them. They will go through their cycles of expectations being a little volatile because people are still grappling with what exact numbers will be there. But these are definitely big opportunities for Indian pharma.
Right, and just a final question, a little more specific on the consumption space. You said you like everything from groceries to real estate. That's a wide variety. Anything that you like more than the other? And if I had to play consumption, do I play it via FMCG or do I play it via quick commerce?
I think quick commerce, discretionary, these will give you faster growth for sure. And you will see even FMCG doing better. So from what I see, that the majority of the results are out, and the outlook given by most of the FMCG companies is they are looking for, say, many of them are looking for a double-digit kind of growth and some expansion in margins also, except for some which are investing in the businesses and they may see margin pressure there. FMCG-like companies, they get their major re-rating when people are confident about steady long-term growth because their cash flows are very good. These are very good brand businesses, good cash flows. Once people get convinced, okay, I'm not seeing any market share loss or I'm seeing better times for the next few years, then those guys get rated upwards. So it will move selectively. I think from January onward, we've seen some selective re-rating upwards in them. They will give you steady growth. The delta may come in Alcobev in terms of discretionary spending in consumer and real estate is what we are quite bullish on.
Take that point, Nimesh. Thank you so much for joining in and giving us your perspective on the markets and the way you feel about the markets. A little more optimistic than what the screen has on board for you right now. Though there is consolidation, the one stock which is on our radar all through this morning is Dixon Technologies. Good numbers coming in as expected, but the stock under pressure. That's largely on account of perhaps the fact that they fell short of their full year guidance on revenue, but more importantly, lack of valuation headroom available out here. Saurabh Gupta, who's the Chief Financial Officer of the company, joins in now, down 7% for Dixon Tech. Saurabh, thank you so much for joining in. You did see good growth. For the year, it was 120% on the revenue, but still short of that 40,000 crore target that you had for the entire year, and higher contribution coming in from lower margin products like mobile segment, etc. So if you could give us a sense on what your prognosis for FY26 is when it comes to revenue and product contribution.
Yeah, clearly we have a very strong order book across all the verticals led by mobiles, and even the IT hardware now from this fiscal year will start to deliver numbers. And we've already formed a large partnership with Inventec, which will really add to the profitability and revenues in the coming years. There is a huge focus on backward integration. We are getting into 4 component categories. We will leverage this component scheme announced by the government. So my sense is, in revenue-wise, we can expect a 40-45% revenue growth this year. And we feel that through operational efficiencies and also through backward integration play, and also through higher contribution of some of our refrigerator business, which is higher margin business, I think so there can be some margin expansion, which one can expect in this current fiscal as compared to the last year.
How much could the expansion be?
My sense is we can expand the margins by 20-25 bips in the current fiscal as against last fiscal on a much higher top line growth.
Okay, all right. Saurabh, there have been some reports of slowdown in mobile phone sales post the festive season, in the earlier part of this year. What were your volumes like in Q4? I do understand that it was quite flat on a sequential basis. And what is the ramp up that you're expecting, and what are the headwinds that you're facing when it comes to these sales?
Yeah, one of the reasons our revenues are flat on quarter basis is basically the mobile revenues were kind of flat. Of course, the margins were slightly better. So we closed the year with around 28 million smartphone volumes. Last quarter, my sense, it was somewhere around 7 odd million. But we are expecting a significant growth this year. This 28 million can potentially go to 43-44 million, out of which 10 million can come from exports. So there'll be a significant jump in export volumes. So last fiscal year, we just did 1.5 million of exports for our anchor customer. And this year, we are expecting almost 10 million worth of exports. So that will be a large jump for us. And our big upside can happen in 26-27 when our JV with Vivo should start delivering. So then we can expect a volumes of somewhere closer to 65 odd million. So clearly, in the next couple of years, I think so we should be able to more than double our revenues and volumes in the mobile business.
All right. Hi, Saurav. Good morning. Good to see you in. Nigel on this side.
Hi, Nigel.
A quick question with regard to this export contribution that you have. As a percentage of business, how much is exports? Where do you see this number headed?
Yeah, so Nigel, last year it was around 5% of our revenues. So on 39,000 crores, broadly 5%, 1,700, 1,800 odd crores. This year, my sense is that number can be almost closer to 9 to 10,000 odd crores. So both as a percentage and both in absolute numbers, that number will increase for the company. And exports is a natural trajectory for our growth. We think that exports as a percentage of revenues will keep increasing given the geopolitical tailwinds now in India's favor, and also companies like us really investing in backward integration, companies like us attaining a particular scale and size, and matching those cost structures at a global level.
Okay, all right. Just one more question with regard to these exports. Could you tell us, is there a realization difference between exports as well as domestic? And in turn, would there be a margin difference as well?
Yeah, so definitely both in terms of realization, definitely, Nigel, it will be at a much higher selling price because the global markets, it's more high-end products and all more 5G products. And also some of the customers are also from whom we are manufacturing have higher selling prices. So clearly it will definitely much higher on the selling prices. And I feel it will be margin accretive for the company as well.
Right. In realizations, what is the difference and how much margin accretive? If you could just give us a brief idea, that it'll help, it'll help us going ahead as well.
My sense is every year the ASPs are going up, and I expect that the selling prices should go up by another 8 to 10% this year. So that should lead to a significantly better growth than the revenue growth, yeah. But then the volume growth, yeah.
From a industry standpoint, what are your thoughts? Because you said that there are manufacturing tailwinds for India. There definitely are, but some say the tailwinds may have slowed down largely because of the US-China trade deal that has happened. So maybe increased manufacturing orders may not come to us at the pace at it would be earlier. I wanted you to chime in on that. And what's the growth visibility that you have beyond FY26? You said 40-45% for FY26, and thereafter you have the Vivo contract coming in. With the kind of capacity addition that you're doing and the contracts that you've been signing, if you have a visibility for beyond FY26, maybe all the way up to FY30?
Yeah, just to answer your second question first, I think so 27 can be even a larger growth for us. Of course, led by mobiles, IT hardware, and of course, the other verticals as well. So we expect that in next 2 years, I think so the revenues for the company has the potential to more than double from 39,000 odd crores that we closed in the last fiscal with a decent margin expansion. And as far as your first question was concerned on the tailwinds, clearly for some of our anchor customers, we have expanded our capacities by 50%, and we are seeing a 50% growth in that order book. And when I said that 1.5 million potential exports for last year can go to 10 million, it is mainly on account of this geopolitical things which are evolving right now. So my sense is even after the tariff on China or the trade deal that China and US are having, there's still a decent arbitrage and will be an arbitrage between India and China as far as the duty structures are concerned.
Okay, so you're expecting a positive arbitrage to play out for you. Your consumer electronics division, Saurabh, your TV category especially continues to be under pressure for many quarters now. What were sales this quarter and why is that? What are you trying to do to revive it?
Yeah, so TV definitely has been in pressure. This has a structural issue, and not only in India, globally, TV sales are coming down. People are consuming entertainment on other mediums. So clearly, there's a shift in consumer preference. So one, we are getting into more categories like displays, IFPDs, and all. And also, we are trying to forge some partnerships in this category, which will, of course, help us get some more business, and we'll try to bring this business back on track. So a lot of efforts are being made. But our other piece of consumer electronics, which is refrigerator, is doing very well. In a short period of time, we have been able to take a large market share in this category. And we expect a 45-50% growth in that category, and which is also coming at a very high margins for us. So yeah, TVs, yeah, my sense is there was a dip in volumes, but yeah, we are making some efforts to get into more categories, getting into some more ODM-driven products, and try to get into some kind of a partnership.
Okay, all right. Saurav, there's this big China plus one and India being the beneficiary. Now, considering the tariff uncertainties, is there any possibility that Samsung, Vietnam as well as Motorola will shift their global production basically from the Vietnam to other countries, to India? That is the hope. And is Dixon expected to be a beneficiary of the same? That entire shift from other countries to India? And has your phone been ringing with these kind of inquiries? Go ahead.
Yeah, so Nigel, definitely the inquiries have significantly increased. And one of the customers that you mentioned two customers. The second customer, definitely, I mentioned that is a customer we are expecting a significant increase in volumes by almost 45-50%. And out of which 50% of those volumes will be for the export markets. So clearly that shift or that the movement has already happened for us now, at least for one of our anchor customers.
If you could give us a couple of more details here. One is what is your current ODM share of your overall revenue? Because that's a margin accretive business. Where do you intend to take that? That's point number one. And secondly, while the benefits of PLI start to wane off, you are doing the backward integration. So what is that offset likely to be? Because you're targeting revenues doubling, say 80,000 crores over the next couple of years with significant margin expansion. What are the drivers for the margin expansion? How much of that will be because of increasing ODM mix, increasing export mix, and your backward integration? And how does that get offset by the PLI benefits?
See, as an overall number, ODM is significantly increasing for us, but as a percentage, it may not be reflecting because a large part of our growth will be coming from mobiles and IT hardware as a category, which is majorly prescriptive driven, and we don't have our designing solutions as of now on both those categories. But my sense is the margin will expand. One, on account of the backward integration play. So we have narrowed down on 4 components. Displays, we have already signed up with partnership on HKC, and which is expected to, the trial should happen by Q4 of the current fiscal, and the mass production should happen from Q1 of next financial year. Secondly, we are in advanced stages of closing our partnership on camera modules. And then 2 other components, which is lithium-ion batteries and enclosures, we are actively working on. So we feel that all this component play will come at a very high margins for us. It adds a lot of strength more into the business, and from getting into this backward integration, I think so we should be able to overcome the loss in the PLI income that we are booking in our books. And also we are working a lot on driving our operational efficiencies, working a lot on automation, robotics. So that's a continuous work right now. And we feel that through a combination of all these three things, not only will we be able to mitigate the loss on the PLI thing, but also we'll be able to expand our margins in the next couple of years.
So what margins are you targeting on an 80,000 crore top line?
And next couple of years, if everything goes as per the plan, I think so there can be possibility, if not more, at least a 90 to 100 bips kind of a margin expansion is possible.
All right, Saurabh, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Dixon Technologies. But now let's shift focus to the entire hospital space. We have Max Healthcare. They've reported what was a stable performance in Q4 with occupancy coming in at around 75%. The company's seen a decline in the EBITDA per bed due to a new hospital addition in Dwarka. To discuss more on this and the company's Q4 performance, we have Abhay Soy, who's the chairman and the MD of the company, joining in now. Abhay, hi. Thanks very much for taking the time out. This is Ekta. If you could just start by giving us a sense in terms of the EBITDA per bed. It's come down this quarter, 73.9 lakh versus, say, 76 lakh same time last year. Tell us on a normalized basis, what was it and what were the key trends, considering that you did have Max Dwarka, which was added into the mix this quarter?
Well, Max Dwarka wasn't added in the mix this quarter. It was added earlier last year, month of July. It broke even in a record time of about 6 months. And presently, at the exit of Q4, it was operating. It's a 300-bed hospital. We've operationalized 235 beds over there. It was operating at a 73% occupancy with about approximately a 30 crore revenue for the month. But having said that, it's sort of marginally brought down the overall EBITDA per bed. But I think the thing to focus is on really ROCEs, right? I mean, we've also done 3 other acquisitions last year. We acquired Lucknow, which in the first year of its acquisition has grown by 56% revenue and 106% as far as EBITDA is concerned. We acquired Nagpur earlier on in the year, which was March last year, which again has grown at 26% top line and 56% on EBITDA. We acquired JP Hospitals, which is the marquee hospital in Delhi, which was in October, November last year. And that is, yet being integrated, but yet it's has about 21-22% EBITDA margin. But having said that, some of these acquisitions, obviously, they don't have the same EBITDA per bed presently, but that's exactly where the opportunity lies in sort of moving that up.
Exactly. You have a lot of moving parts, Abhay, considering that you have a lot of these acquisitions which will be integrated into the fold in the next couple of quarters. So give us a guidance in terms of what we can expect on the EBITDA per bed, or what we can expect in terms of occupancies and possibly the RPOPs going forward.
With respect to RPOPs, you've seen, our previous hospitals have had an RPOP increase of about 7.5%, which is pretty much in line with how it's been performing every year prior to that. We've also had occupancy of 78% of erstwhile hospitals. If I take out the occupancy of Dwarka, which obviously has been ramping up, which is the new hospital, then the overall occupancy again is close to 77-78%. But because of the newer hospitals, and particularly what we acquired in the month of October, November, which was the 2 JP hospitals in Noida and Chitta, they have an overall occupancy of 46-47%. And that is what is sort of dragged down, at least optically, the occupancy. But having said that, we've reported a year-on-year increase of 29% as far as revenues are concerned, 26% as far as EBITDA is concerned, and 21% on profit after tax. And that's a fairly sort of a healthy growth, we believe.
Absolutely. International patient revenue, you've had some issues with regards to Bangladesh and Yemen. Has that shown any kind of improvement this quarter? And what are you guiding for, considering that, there was around a 28% growth in Q4 when it came to international patient revenue?
So clearly, we haven't had those issues because, last quarter we grew by 24% year on year. And this quarter we've grown by 29% year on year. So we've been able to sort of make up those loss of those businesses through other sort of direct-to-home fly channels that we've been able to create. So, this business, again, like I said, has been growing by 29%. And again, that's a fairly healthy growth.
I just wanted your thoughts on the run rate for Max at Home and Max Labs. You did about 100 crore combined in both of these in the fourth quarter. At what quarterly run rate can it grow from here?
Well, I don't give forward-looking statements, but consistently they've been around 20 to 24% growth, I think, for many, many, many quarters now. And Max Lab has grown by 22%, whilst, Max Lab has grown by about 20%, whilst Max at Home has grown by 22% in the present year.
Okay. Are you seeing any kind of incremental testing in Max Labs, hospitalizations because of, the recent increase in COVID-19 cases?
So we haven't really seen any increase in COVID admissions. Anecdotally, there have been COVID cases, and but these are very mild COVID cases. I think it's very unlike perhaps what's happening in Hong Kong and Singapore at present. But it's been very mild, I think, all across.
You don't think that could increase in India? I mean, the cases are mild. It's happened in Hong Kong and Singapore, which is a little more. We don't need to worry, right? I mean, not a business question, but this is a genuine question from everyone who's watching and for everyone who wants to know what the trend would be.
It's so difficult and so hard to sort of predict that trajectory because, how this virus morphs, will it morph into something different, etc. It's very, very hard to call. I think it's important to sort of keep an eye out and monitor. And the isolation is a great thing. Anybody gets fever, gets temperature, or any of the symptoms of COVID, or even one believes may not be COVID, right? But it's prudent to get yourself tested and isolate. That is something which has clearly worked in the past, and that should hold us in good measure.
Okay, I just want to come back to the business. Wanted to understand what was the increase in, say, complex cases that you all probably serviced this quarter. I was looking at another hospital company. Robotics revenue has been, over 50% in terms of growth on a year-on-year basis. What was yours in terms of, say, complex surgeries, oncology, robotics, and what are you guiding for, and how is it adding to your margins?
Clearly, I think the 7% RPOP that you see, I think about 2.25% every year is due to price increase. I think everything else is largely due to, and you must keep in mind, when you're already operating at 75% to 78% occupancy, it's incremental. But that would mean it's about at least a 12 to 15% increase on more complex cases, more oncology cases, and so on and so forth. So that has been our mainstay. I mean, you've seen some tower specialties, particularly like oncology, that has been growing at 24-25% per year by itself. So I think, it's just a lot more awareness of it, and perhaps a lot more people are getting sick because of oncology, and some of the other tower specialties as well.
Okay. You're expanding in Thane, which is like a micro market. What's the reason behind that? It's around a 500-bed hospital that you're looking at, and it's going to be an asset-light model, I understand. What is the kind of growth that you're looking at from a micro market like that? And is that a strategy that you're probably going to adopt going forward?
Right. I think a place like Mumbai can host at least 3 to 4 hospitals from us. I think Thane is a extremely, extremely robust market, and we've seen some of our peers do extremely well over there. So I mean, it's clearly been on the agenda for a long time for us. We've been seeking land over there, and we were happy to sort of engage with really a blue chip partner over there to be able to set up an asset light. This is in line with what we are doing in Zirakpur in Mohali, what we've recently announced in Pritampura in Delhi as well. And in line with what we've done in Dwarka, so this asset light sort of model works for us, where somebody else who has the land builds out the hospital and gives it out to us, for a long, long period. 50, 60 years is typically the lease. And, that's how we've been, it's an asset light model. It has high ROCEs for us, and it's in line with what we've sought out to do.
Okay, just quickly then, Abhay, just wanted your perspective in terms of the competition rising within the entire hospital space. We now have Adani's entering into the Ahmedabad as well as the Mumbai market. What is your sense, considering that there's so much PE money within the entire space as well? and you have bigger names, conglomerates which are entering as well?
See, typically PE money is finite over a finite period. They look at an investment over 4 to 5 years. What we need in India is creation of quality healthcare assets. Just the extent that we are underpenetrated. In today's date, we have a baby boomer population, which every year is getting a little older, is getting a little sicker. Awareness is going up. And as we are moving towards being a $5 trillion economy, you have people's affordability index has moved up. And, just frankly, our expectations of public spaces has significantly improved. I mean, look at the kind of airports we go to, right? PE money, fortunately, unfortunately, is largely deployed towards M&As and then exits because, to build out a hospital can take you 4 to 5 years. What you do need is money, long-term money coming, from the likes of Adani and others, etc., to build these healthcare assets because, that's how assets are going to get created. It's not necessarily going to be done by PE money. In fact, I would vouch that perhaps won't be done by PE money. I mean, we ourselves are opening in the next 90 days or 120 days, we're going to be opening 3 new hospitals. Mumbai hospital will be ready, the Saket one in Delhi, then we are going to be opening Mohali and so on and so forth. I mean, last year we were 3,500 beds. At present, we are close to 5,000 beds. By end of the current financial year, we'll be 6,500 beds. And, by 2028, we should be 9,000 beds. But, clearly what we're also doing, all the profits that we generate, all the profits that we make, and I can say this for the entire industry, it's not really a dividend paying industry. This thing sort of goes back to creating more healthcare assets, which are so needed in the country, right? I mean, we're just the extent of underpenetration. And you require all sorts of formats, you require all sorts of investors. Adanis have a deep sort of pockets and also have been nation builders in so many ways. So, we're welcoming all of this.
Okay, all right, Abhay, we're going to leave this for a longer conversation next time, the changing landscape of the entire healthcare hospital market. Thanks very much for joining in and speaking with us. Well, that's Max Healthcare. They are expanding to around 9,000 beds in the next couple of years. We need to take a short break. However, on that note, up next, we'll be talking to Akshay Kumar Singh of Petronet LNG, who'll join in to talk about their earnings. Stay tuned.
Welcome back. Well, the markets actually have zoomed up. So the initial dip got bought into, and now we're at the high point of the day. So good move out there. And one stock that's standing out actually is Tejas Networks. I don't think we have yet referred to it. Post its numbers, the stock got slammed because there was no big order win that they saw. Now, earlier today, TCS had put out a disclosure that they had won an order, and in turn, Tejas benefits as well. So Tejas as well has put out that they have won close to 15 to 1,600 crores of order inflow. So it seems, at least in terms of the order book, some part of that is getting resolved. Now we'll have to track the receivables and the operating margin performance as well, because the last quarter had a couple of one-offs. So keep an eye on that, up close to around 3.5% after getting slammed more than 20% post its numbers. Well, let's get chatting with Mr. Akshay Kumar Singh, the MD and the CEO at Petronet LNG. Hi, Mr. Singh. Good morning, and thanks a lot for speaking to us here on CNBC-TV18. Well, in the past year, your volumes got hit and your utilization levels as well were under pressure. However, the street is optimistic that demand will come back in the coming year. So in terms of number of units, what kind of volumes can you guide us for in FY26 that compares with FY25? And also, if you could break it up for us, how do you expect capacity utilization levels to improve at Dahej as well as at Kochi that was very, very low in the past year? Please go ahead, sir.
Good morning. And I would like to express my heartfelt gratitude to CNBC team for inviting me to share insight data. Last year had been very good for the gas market. There was almost increase of 4% gas utilization across the country. And particularly the LNG side, there was almost 10% increase in the import and consumption of LNG. And PLL, being a leader in the LNG business, both the terminals have utilized the maximum capacity with respect to the previous year. Our volume total combined is highest ever in the history of Petronet LNG. We processed 934 TBTU of LNG, both combined our terminal. Going forward in FY26, we expect that this momentum will continue. The basis of this assumption is that in the latter part of this FY26, it is expected that almost 40 million ton of LNG capacity added across the globe, particularly in US, almost 25 million ton per annum, and Canada, 15 million ton per annum. So with increase of the LNG availability in the market, the prices are expected to be softened, and that will help the more import of the LNG in our country. We are in the process of expanding our capacity at Dahej, which is presently at 17.5 million ton. And last year, almost we utilized 17 million ton capacity at Dahej. And in coming 3 to 4 month times, we will be increasing the capacity from 17.5 million ton to 22.5 million tons. And that will give us the leverage to handle more volume at Dahej. Dahej is being the unique terminal in the country which has a unique feature of world's busiest.
Mr. Singh, just wanted a couple of numbers, sir. We've got that. You know, the graphic plate is telling you about that capacity expansion from around 17.5 to around 22.5, MMT, which is good. But for the year, last year you did 17 from Dahej, and from Kochi, I think it was in the ballpark 1.5 approximately. For this year, what kind of a volume, sir, can you do?
Yeah, see, as we know that the import of LNG is largely dependent on the prices, and the expectation is that when the more capacity is added, the more volume will be coming, and we will be able to handle the large part of those volumes. Our 4 of the off-takers, major off-takers, that is IOCL, GAIL, BPCL, and even GSPC have signed 5 million ton term contract in recent past, and those supplies are expected to flow from the end of this FY26, and that our expectation is that they have already booked the capacity at Dahej, and large part of those volumes will be flowing through our terminals, and that will improve the capacity utilization of Dahej. Coming to Kochi, as we know that the constraint is the connectivity to the Bangalore, and we expect that by this year end, by December 2025, the connectivity will be completed, and then the Kochi terminal will be connected with the national gas grid, and our utilization will substantially improve from the present 23-24% to maybe gradually it will go to 50, 60, 70, 80 like that.
So short point from the 930, 940 TBTU that you did all of last year, this year it can go to about 1,050 TBTU. Is that a possibility?
Yes, it is a possibility, because it only the prices may hold, but our expectation is that the prices will be stabilizing in this year.
You know, just one question before we let you go, Mr. Singh. The PNGRB recently announced regulations with regards to registrations of the LNG terminals. Now, you have 2 tanks which you are looking to set up, one in Dahej, which you pointed to, and the other one is in Gopalpur. Now, because of these new regulations, do you think there could be a delay in implementing these? Because you may have to then, ask for a separate registration requirement, even in existing places. That's one. And the second one was the petrochemical project. Is it on time? Is it likely to open in FY27?
So, first of all, the PNGRB registration process, which is notified, we don't see any challenge to the Petronet LNG, particularly our major terminal, Dahej, which was set up before the appointed date. There is no need of any registration for the Dahej terminal. We have to just intimate to the PNGRB. And even for the Kochi and coming Gopalpur, which has already been approved, we don't foresee any challenge. And in fact, these registrations requirement was a part of the act which was passed by the parliament in 2006, but nevertheless it has come now, and it is a process of registration, nothing to do with the regulation of this infrastructure development and the tariff regulations. So that is the first part. Second part, on the petrochemical, our project is going in the full swings. It is a 20,685 crore capex project, where the hard cost is around 14,600 crores. And the entire project has been divided into 300 packages, and 11 packages, which are the long lead items, has already been floated in the market, and we have already received 7 bids against that. Also, there are 13 EPC packages costing around 7,000 crore, which has also been floated in the market, 8 packages worth 6,000 crore, and we have already received the bid of 3 packages. So entire petrochemical project is on schedule, and we are targeting to mechanically complete by October 2027, and by March 2028, the entire process of commissioning and stabilization of plant will be done. Everything is moving as per the schedule and on track.
Sure. All right, so we're going to leave it on that note. Thanks very much for joining in. That's Petronet LNG. They are expecting the volume growth momentum to continue into FY26 as well. Well, let's move on. Fortis Healthcare reported what was a good operational performance in Q4. The margins improved both sequentially and annually, led by stable hospital and improved diagnostic margins. Our colleague Vinny Motiwala spoke to Dr. Ashutosh Raghuvanshi, who's the MD and CEO of the company, and began by asking him about the margin outlook for FY26. Listen in.
We have stated in past that we would see almost a 1.5% to 2% year-on-year improvement in margin, and we have delivered on that. I think that trend will continue. It's coming on basis of a lot of factors, essentially, which are driving this progress.
Okay. And what are these factors, and how much more improvement can we expect in terms of margins now in FY26?
So there are many factors. One of them is, of course, occupancy, which has been steadily improving. So last quarter, we had about 69% occupancy levels. We expect this to go above 70% in the coming year. And that is one of the drivers. But the case mix is another driver. A lot of our hospitals have been equipped with robotic services, and we have done large number of robotic cases. So that area has been growing. Oncology has been growing steadily as well, where the ARPOBs are typically higher. Our bone marrow transplant units have been doing very well. The hematology service is one of the largest in the country. And at the same time, we also are adding brownfield capacity. As you might be aware that some of that, about 800 beds, which are supposed to come during this year, some of them will come in early part, and some of the beds will come towards the end of the year. But early on within this quarter, we will see some beds getting added in Noida and Faridabad. That will also give us further flip to our profitability.
Okay, further improvement with all these factors in terms of profitability. Mr. Raghuvanshi, you spoke about ARPOBs also. We were talking about occupancies. Both these have actually started seeing an improvement. I have seen an improvement actually in the quarter. How much did key segments, I want to know, like surgical revenue and complex cases actually contribute in this quarter? Was there a significant increase on that front?
Yes, so our surgical cases is approximately about 60%, and 40% comes from medical patients. So that has been a big contribution. And as I said, complex surgeries have been happening more, and that has contributed to bring this number.
Okay. Mr. Raghuvanshi, one more point you highlighted was in terms of robotics side. You just touched upon it, but I want to know robotics. That was up by 72% when I look at it in FY25. And neurosciences, that also is up significantly, 17% YOY. Could you give us a sense in terms of how much did they contribute in the quarter in terms of revenues, EBITDAs? What is the outlook for this in FY26 as well?
Yeah, so neurosciences has been going steadily, and that is on basis of the new equipment we have done. We have got a gamma knife, which is a precision therapy, and that has done very well. We have got other radiation oncology facilities also, which are very specific for neurosciences. So that has contributed. But all these segments have been growing. But the fastest growing segment for us has been oncology, where we have seen about 21 to 22% CAGR over the last couple of years. And that trend seems to continue. Earlier on, our cardiac sciences formed the largest segment, which still does. But the oncology is catching up fast, and so are the other specialties. Robotics, especially as you asked, a couple of our units we have got 2 Da Vinci robots, and many of our other units have got 1. And the numbers have been growing very fast over there. There are a lot of advantages in robotic surgeries, and that's why many patients are opting for these procedures.
Sir, what I also want to know is in terms of occupancy as well as ARPOB. Now, overall also, occupancy for FY25, I'm looking at the full year, that's at 69%. ARPOB, 2.42 crores. Manesar Hospital, that has also done well, right? We're picking up traction in that front, operating at 38% occupancy. That's very interesting. So for FY26, overall, what are we expecting in both these numbers? Occupancy, what will that be? And what is the ARPOB that we're looking at?
So yes, I'm expecting about 72% occupancy at a network level. Manesar facility is a new facility, as you know, and we are currently operating only 90 beds. But month on month, the occupancy numbers are going up, and we expect those numbers. We expect to add another 120 beds within this year, and also close the year by at least about 50% occupancy in Manesar specifically. But overall, at the network level, we expect it to be about 72%. ARPOB has steadily been growing quarter on quarter for last many quarters, and I think that trend will continue. However, that will be slightly moderated as we go further because of multiple factors, primarily the capacity enhancement. And for that capacity enhancement, we would also be accepting probably more scheme business than what we do at the moment. And that might moderate the ARPOB a little bit. But ARPOB growth has been very significant over the last, I would say, about 8 to 10 quarters, and that trend will continue.
Okay. Sir, a question just in terms of diagnostic front, right? Because the growth has just been 3%, though margins have seen a very good improvement. I want to understand, the scenario that is playing out here. What is the outlook also that comes in from the diagnostic front of the business?
Yes. Our diagnostic business certainly has underperformed compared to the industry peers. There have been multiple reasons. One of the major ones was our change of brand, which we did about 1.5 years back. That impact is now gradually weaned off, and now we are seeing a steady growth happening. And that's the reason why the growth numbers are so low. However, profitability this year has increased compared to the last year. And that trend will continue. This year focus is to build this business further and improve the profitability profile as well. We are very hopeful that this business will do well for the simple reason that we have a lot of focus on genomics and other specialized tests. At the same time, we are strengthening our retail network of patient touch points. We have almost increased about 800 touch points in the last year. So that will improve our lab economics per lab as well, and that give us an upside on the lab business. Our objective is that in this year, we want to achieve industry level of growth, both on the top line as well as have the similar margin profile.
So that is going to be almost around, we could expect at least double-digit growth, right? High single-digit to double-digit growth is what we could watch out for?
Absolutely.
And margin profile, you said, will improve further, right? Because there's so much lab economics is going to be improving. So right now, around that 18% mark, how many more basis point improvement could one see in FY26 here?
We expect to go to at least about 21%.
Okay, that's going to be interesting, 21%. So that's something that we're watching out for as well. So, in terms of international revenue, I just want to touch up on that point, international patient revenue that's there. Contributing to around 8% of your total contribution, 17% increase YOY. What are we watching out for in terms of a guidance there? Any bit of a worry coming in there, or you expect this to see an increase coming in, given the current scenario that we're seeing in terms of geopolitics?
Yeah, in the current scenario, we are a little cautious about how much growth we are going to see here. But we are pretty certain that the numbers are going to remain steady. So we may not see the same level of growth, about 17% growth we saw from last year to this year. That level may come down to maybe 10, 12%, but we will certainly see a growth in international patients. There were many, many events which sort of reduce the numbers of international patients coming to India, especially from Bangladesh. And now with the current situation, there is also a hesitation from other places. But so far, we have not seen any numbers going down, and we are seeing a steady number of patients coming.
Okay, all right. So that is Fortis Healthcare talking about what they are expecting in terms of improvement of margins. 1.5% to 2% improvement in terms of margins is what they're looking at. The stock is up around 1%. They've seen a huge rise in terms of robotic surgery this quarter gone by. But Chandan Taparia joins in to tell us what he's strategizing. Chandan, quickly, if you could just tell us what your calls would be now.
Yeah, good morning. Thanks for having me. So I believe that Nifty has taken support at lower band of the trading zone. So till it holds about 24,444, we are expecting index to again hit towards 25,100 to 25,200 levels. Looking at the trading ideas, first trade is buy on BL, positive on the defense name. And after the consolidative move of last two trading sessions, most of the defense counters are likely to see the positive momentum. So here we are suggesting to buy on BL. The stock has seen the open interest addition of around 3 to 4%. Longs are intact, has been making higher top, higher bottom. So recommending to buy with support of 370. And this stock has potential to rally towards 395 to 400 level. Second trading idea, there is buy on escorts. Selective auto counters are forming the bottom. And escort has been holding well above 3550 zone. We are witnessing a consolidation breakout of last 5 to 6 trading session. And technically, it is a pattern breakout of bullish pole and flag. So expecting further rally in the counter. With support of 3495, we are expecting a rally in escorts, which can take it towards 3700 zone. Apart from that, I believe M&M can do well in auto pay, has been consolidating, but supports are intact. With support of 3030, it can head towards 3250 level. So two auto pay and most of the defense counter could be on radar for the day.
Take that point, Chandan. Thank you so much for joining in. As you speak, the market continues to surge 24,850 on the Nifty at the high point of trade, being led by all the sectoral indices. The Nifty Bank up around 0.02% as well. Take a short break, come back on the commodity space. Manisha Gupta joins in.
Welcome back. Well, for the markets, definitely picking up pace. We have the Nifty, which is up around 185 odd points. The mid-cap index is also doing well with a gain of around 0.7%. Just watch out for GSK Pharma. That stock is doing well, up around 7.5 odd percent. JK Tyre has now moved into the green, so that stock is up around 4 odd percent post a sluggish start. But shifting focus to the commodity markets, Manisha is here to tell us what she's tracking today. Manisha.
Well, thank you so much for that. I'm looking at the precious metal overall as a sector because we've seen stronger gains in the overnight markets. To begin with, it is the decline in the dollar index, which has been supportive. And then the markets also are taking cognizance of the ongoing tensions between Russia and Ukraine. While there have been some conversations, but we are far away from that ceasefire or even both the leaders sitting together and talking on. And then it is about European Union and Britain now putting further sanctions against Russia. From European Union, this is the 17th package of sanctions that we have seen come in on Russia. So the sanctions is on 75 entities now, which brings the total list to 2,400. It is inclusive of individuals, institutions and companies as well. Also, what we have seen that there are measures also for tackling chemical weapons, human rights abuses and hybrid threats. Also in the list is sanctions on shadow fleets and oil companies therein, and even a couple of mining companies feature in that list there. It's not just about gold, which has gained up by 2% overnight, but silver prices also gained a couple of percentage points on the higher side. For silver, it also is about safe haven demand, not in sense of jewelry or artifacts, but in sense of bullion. And the industrial demand for silver also seems to be picking up quite strongly. The higher investments in solar panels across globe is what is supportive of demand going forward. If you look at the numbers therein, the Chinese wind and solar industry for the first quarter has seen very strong numbers come in to the tune of 1,500 gigawatt. And within this, 50 gigawatt has been only from photovoltaic power. Not just China, European solar power output also has surged in the first quarter, supporting silver demand. And it's not just gold and silver as well, because when you look at platinum, palladium, we are looking at prices surging there as well. Palladium is trading at a 3-month high, trading above $1,000 an ounce there. Now, remember, Russia is the world's largest producer of palladium, and we are looking at a deficit for this year and the next as well. Last year was a deficit of 400,000 tons, and this year the markets anticipate a deficit of 254,000 tons. That in turn would be supportive. Coming to platinum, and we've seen 5.5% of gains overnight. This one also is trading at a 7-month highs, and we are trading above $1,050 an ounce for platinum as well. Russia is the world's second largest platinum producer, and last year was a deficit, and this year we're looking at a third year of deficit continuing to the tune of around 476,000 tons. Markets anticipating that you could be looking at gains continuing for precious metals in the day-to-day.
Right, Manisha. Right, Manisha, thanks a lot for that. With that, we'll take a short break. On the other side, we have the management of CMS Infosystems joining in to detail their earnings. On the other side, Rajiv Kaul joins in on the back of their earnings.